Thanks to all of you for being here today to hear about something that happened a long time ago, but was a relatively big feature of the financial crisis. So I think it's worth going back and taking a closer look at what happened. So why do we care? As I said, AIG was a big piece of the crisis. $182 billion was committed to that one company, which is pretty startling and staggering when you think about it. And if we better understand what happened at AIG, we can better understand the reforms that are necessary to prevent such things in the future. And I would argue that the reforms that were put in place in response to AIG are not really very responsive to the problems. And I think part of the reason for that is that we've left out a part of the reason that it got into trouble. So we're going to look at why AIG got into trouble, why the government intervened, and whether Dodd-Frank reforms address those problems. So the typical view of AIG is this view, which former CFTC Chairman Gary Gensler repeated quite often, which was that AIG Financial Products, which was a hedge fund-like entity based in London, nearly brought down AIG and nearly brought down the American economy. That makes a great story, but it's not entirely accurate. So this is another extreme on the other side, and this is a much rarer view that's expressed by Paul Tucker here from the UK. He said AIG blew up when its securities lending shadow bank, an insurance company, suffered a run. And that's the piece of the story that too often doesn't get told. So AIG was founded a long time ago. It was founded a long time ago, and it actually started in China. And it was an insurance company to begin with, and it gradually expanded into other business lines, but really focused primarily on insurance. It was in 130 countries by the time of the crisis, with 116,000 employees, millions of customers, and it had a legendary CEO who was at the company for 4 decades, Maurice Hank Greenberg. Well, Mr. Greenberg had a little run-in with later Governor Spitzer, who was not governor at the time, who did not like the way Greenberg was running the company and essentially forced him out of the company. And I would mark that as the beginning of the company's real troubles. So in March 2005, when Greenberg left, Martin Sullivan took over. He was an insider, and the company ended up settling some of the charges that had been brought against it and trying to move forward. But by June 2008, the company was really losing money very fast, and at that time, they replaced Willemstad with a new CEO. AIG had a number of business units: general insurance, life insurance and retirement services, financial services, and asset management. A lot of what we're going to talk about today happened in the life insurance unit, which is, again, part of the reason probably that people don't like to tell this part of the story. Contrary to popular myth, AIG was really heavily regulated. In fact, it had hundreds of regulators. And that partly stemmed from the fact that it was engaged in many different countries. So each one of those foreign countries would have had a regulator regulating it. The 50 states regulated it. And then for the different pieces of Dodd-Frank, you also had different domestic supervisors. The Office of Thrift Supervision, which is no longer in existence, in part because of what happened at AIG, was the holding company regulator. So they got to look at the whole company. And a lot of people criticized the way that they carried that job out and think that the Fed will be able to do a better job, which is not entirely clear to me. AIG FP, which was the source of the derivatives that caused AIG so many problems, was a relatively late addition to the company. It started in the late 80s. And the second guy in charge of AIG FP had a key governing principle, which was no mortgage-related assets. You can get involved in lots of things, stay away from mortgage-related assets. Well, that didn't last. You've got Joe Cassano. This picture of him is relatively famous. He's the one who was heading AIG FP at the time of the troubles at AIG and got a lot of negative press. He loved mortgage-related assets. And so they started offering credit default swaps, which is a type of contract, it's a derivative. And what AIG was essentially doing, what AIG-FP was doing, is they were selling protection. So if you had a bond and you wanted protection on it, you could buy one of these products. People also use them, they use them to manage risk, and they can also just use them as part of their investment strategy. But what essentially AIG-FP was getting a stream of payments from the people who would enter into these CDS contracts with them. And in exchange, what AIG-FP promised was, if you end up having trouble, we'll come in. If these underlying bonds are troubled, we'll come in and we'll help you. And AIG-FP was really attractive because AIG, the parent company, and AIG-FP, they had strong credit ratings, and so people thought it was a trustworthy, they thought in a time of trouble, AIG would surely be there. AIG-FP sold a number of different types of CDS. We're going to focus today on multi-sector CDS, which were CDS written on CDOs, which combine a bunch of mortgage-backed securities. Now, they're called multi-sector CDOs, but in reality, they were heavily concentrated in mortgage-related securities. So this is the definition here of a collateralized debt obligation. I don't want to overwhelm you with too many of these terms, but it's a bundle of debt that's put together, and then it's broken down into tranches. So as I said, there were lots of residential mortgage-backed securities in those CDOs. And normally, when you're a CDS dealer, which AIG-FP was, what you would do is you would hedge your exposure so that you would make sure that if something bad happened, you were protected by being on the other side also. AIG-FP didn't hedge. The head of AIG-FP had another idea, which was that he would hedge his exposure by only offering protection on the top level of these securities. So I have a picture here, and this is from one of AIG's presentations that it gave, and you can see the securities that go into the CDO, and then you can see that FP is writing protection only on the super senior risk layer. So this is another picture of the same thing. And so AIG-FP wouldn't be on the hook until that attachment point. So it seems like, you'd have to go through all these losses before you actually got to AIG-FP. So that seemed like a pretty safe strategy. What could possibly go wrong? Well, Goldman could call you. You could want money. And that happens when the underlying securities are doing poorly. Goldman, who was on the other side of these transactions, was one of the firms on the other side of these transactions, would say, hey, look, we need to get some money from you to ensure that if there's a real problem, you'll be able to pay up. And so this started in 2007, and Goldman and others started asking AIG-FP for a lot of money. And AIG-FP pushed back, which was relatively normal. You have these kind of discussions about, well, our models say X and our models say Y. Now, AIG-FP was a little bit hindered in this, that it didn't have a model really of its own, so it was in a weaker bargaining position. In any event, so you can see the losses. The losses are in the blue, mounting up against the net notional value of these CDS that AIG-FP was offering. So the situation was a grave situation. It was a big liquidity drain on AIG-FP. The company just wasn't prepared for having to ship that much cash out. But the problem could have been a lot worse. And that's because AIG had stopped writing these CDS contracts on multi-sector CDOs, which are the residential mortgage-backed securities CDOs, because they saw that there was something going on, something strange was going on in the residential mortgage market. And they decided, you know what, we're going to cut off. Even though this is a lucrative business, we're going to stop it. But they decided that they would keep their existing positions and they wouldn't enter into hedges. of those positions. And so that's where they ended up getting into trouble. So while AIGFP was analyzing the mortgage market and realizing something's terribly wrong here, other parts of AIG were going merrily along, and they were continuing to expose themselves even more heavily to residential mortgage-backed securities. And one part of AIG, one big part of AIG that didn't get the memo on that, was the securities lending part of AIG. So that's what we're going to talk about next. What is securities lending? So securities lending is when you have one party that has a lot of securities. So insurance companies have a lot of securities in their portfolio, so they're a perfect candidate for this. And they can lend those securities out, and then they can get cash in return as collateral. And then they can take that cash and they can invest it in other things. Now, typically, what's done is that these are very short-term loans, so they can even roll over every day. They're definitely shorter than a year. And so you're sort of counting on the fact that the loans are going to be renewed. The securities are borrowed by hedge funds and broker-dealers who might be using them for short selling or financing strategies, or for the repo market. It's closely linked with the repo market. But basically what the insurance company that's participating in this gets is they get a little extra from reinvesting that collateral. And so it's a little bump to their income. Typically, they'll get 102 to 105% of the value of the security in collateral. And they maintain that throughout the term of the loan by daily adjusting the collateral to make sure that it's matching it's within the 102 to 105. And then the lender will give to the borrower a rebate. So that depends on how scarce the security it is that they're borrowing. If it's a scarce security, they won't get much of a rebate. Here's a simplified version, and I say simplified because there's an agent that'll stand in the middle of these transactions, and the customer, the borrower, will work through a broker-dealer, the securities lender. In this case, it was all the insurance companies at AIG pooling their assets, and then AIG's securities lending arm would take that pool of securities and they would lend them out, and then they had another set of people who would reinvest the cash collateral. So as I said, it was a joint program, and it's the life insurance companies that were the primary pieces of AIG that were involved in this. All right, so I just want to show you this. AIG, this is the cash collateral that AIG had invested versus the cash collateral reinvested in the rest of the securities lending market across the world. So, I mean, it looks small, but when you think of it, one company, that's a pretty big percentage. AIG's securities lending program grew pretty dramatically, and you can see that here. Keep in mind that this is billions of dollars. And as I alluded to before, they reinvested a lot of their cash collateral in residential mortgage-backed securities. And like a lot of other people, they were putting a lot of reliance on the fact that many of these securities were AAA rated, so they thought that meant that they were pretty safe. This is a little bit hard of a chart to follow, but the stuff in purple, orange, brown, and purple are all residential, or they're all mortgage-backed securities. And so compared to other securities lending reinvestment programs, this was very high exposure to mortgage-backed securities. So what ends up happening is that you owe this cash collateral back to the borrower. You, AIG, owe it back to the borrower. You've taken the cash collateral and you've invested it in something else. So then if those investments fall in value, you're sort of in trouble because you still owe that money back to the borrower. And you can see here that the difference between those two things starts to grow, and in 2008 becomes a huge gulf between what AIG has in its collateral and what it owes. And securities lending transactions that I mentioned are short-term. They typically get rolled over and renewed, but you can get complacent and you can assume that they'll always get renewed. Well, as you know, during the crisis, a lot of things changed, and people were worried about AIG, and so they started to decide, we want our money back. And so what AIG started doing is they started making loans in order to get cash, in order to pay back another borrower. And so their program peaked at $94 billion in October 2007 as they tried to make these new loans to pay people back. So this is a great strategy until the second borrower wants his money back. And then you've got to find a third borrower, and you get yourself deeper and deeper into trouble. Some people have compared it to a Ponzi scheme. So they were also, in 2007, they decided that they also needed to start selling some of the securities from their reinvestment pool. And those reinvestments were longer-term securities than the short-term securities than the short-term loans that they had. And they were selling these securities sometimes at a loss. And so, of course, in 2008, what was the one thing everyone wanted? What did you want to have? Yeah, that's right, so cash. So, these borrowers, they didn't want these securities. They wanted to get their cash back. So what happened? What did AIG do? They started doing haircuts. What does that mean? Well, as I mentioned, the standard is that when you make one of these loans, you get 102 to 105% of the value of the security. Well, one way to keep borrowers coming in is to say, it's okay, we'll take 100%, take 98%, 95%. One of their borrowers got them down to 73%. And this is really a dramatic thing in the securities lending world. If there was a problem, the borrower was, if AIG couldn't pay the money back, the borrower could sell the securities, or in this case, it could actually go after the assets of the participating insurance companies, that was a pretty scary thing for AIG to think about, because obviously you don't want them going after the core of your business. Although the life insurance companies were not the flagship insurance companies of AIG, they were still central to what AIG did. So as a result of this, AIG, the parent company, started putting money in to make up for the difference between the 102% they were supposed to have and whatever under collateralization there was. And they were really required to do that because the contracts with the insurance companies required 102%. The contracts between the insurance companies and the securities lending arm of AIG required that 102% collateralization. And then AIG also put money in to make up for the difference between when the securities were sold from the reinvestments, there were losses, so they put money in to make up for that as well. This just shows AIG, the whole company's income and losses, and you can see that their losses were really mounting pretty dramatically. It got really bad in 2008. And again, these are billions, so it's staggering to think about that. The stock price also started to reflect how bad things were. Another big issue hanging over the company at the time was the credit rating, was AIG's credit rating. If it got downgraded, that was going to be incredibly bad for the company because there would be more demands for collateral, there would be more calls for the borrowing transactions to end, and then it would be harder for AIG to raise more capital, which it so desperately needed. The problem with securities lending, because it touched the insurance companies so directly, could have caused AIG real reputational damage. AIG didn't have the cash to spare to pay out all the demands for the cash. And so in June 2008, when AIG got a new CEO, one of his really primary concerns was actually not AIG FP, it was the securities lending program and the liquidity issues that was posing. So who would you go to see if you had this problem? Well, word on the street was, this was your man. And so actually in June 2008, the CEO of AIG went to see Geithner, and Geithner said, we're not going to help you. Think back to 2008, think how things were. The Bear Stearns sale was in 2008. In March 2008, September, you had Fannie and Freddie get taken over, and then you had Lehman weekend, September 13th and 14th. Lehman weekend was the same weekend that was really a crisis weekend for AIG. So you had teams of people looking at Lehman, you had teams of people looking at AIG. And no private sector folks came forward for AIG. They made some efforts to reach out to different people. Warren Buffett, along with the Fed, they brought in a team of people from different Wall Street firms to take a look at AIG and to see how bad the situation was. And what those guys concluded and what they told the Fed was AIG needs more cash than its assets are worth. That's a pretty dramatic finding. Now, of course, this was all done over a short period of time, so it was hard to get their hands around what was going on. But what they were saying is this company is insolvent. The insurance regulators tried to cobble together a deal to save AIG. They looked at it. The property and casualty companies were in pretty good shape, so they looked at a plan which would take the life insurance companies and make them subsidiaries of the P&C companies. And the hope was that this could save the company, but they pulled that plan. They didn't go forward with it, which I think as regulators of the P&C companies, it would have been unwise for them to take on the larger companies' problems. So why did we rescue AIG? Interestingly, at the time, there's a lot of back and forth within the New York Fed about, do we need to rescue AIG? What is it? And so there are a lot of different reasons that are given for why AIG was rescued, and they were given at the time and they're given now. Things like, this was obviously a terrible time, so would the markets be able to handle another major failure? That was a big driver. What would insurance customers do? The folks were worried, the people at the New York Fed were worried that if an insurance company failed, that their customers wouldn't be able to find another insurance company, which seems like a little bit of a strange explanation. And then they worried about AIG's many counterparties. AIG was huge, had lots of counterparties. And among the counterparties were actually the European banks, which if AIG had failed, it would have been tremendously difficult for those banks. And so that likely played into it as well. Fed came to the rescue. It came to the rescue with an $85 billion loan. It used its provision of the Federal Reserve Act 13.3, which enables it to make loans. And that provision has since been changed to make it, you couldn't do this kind of single company loan. You'd have to do it through a broader-based program, although that can obviously be gamed. This was collateralized by AIG's assets, but as I mentioned, there was really feeling on the street that AIG's assets weren't worth $85 billion. So one could argue that they violated the requirements of 13.3, which requires that the loan be collateralized adequately. Of course, the language is fuzzy, so they could probably get around that too. AIG was spending money at an alarming rate. The drain of cash did not stop when the Fed made this loan. You can see securities lending borrowers asked for $24 billion between the 12th and the 30th of September, which is amazing. And so what did the government decide it had to do? It had to come in again. It came in multiple times and changed the terms of the loan, and then ultimately TARP funds were injected into AIG, and Maiden Lane 2 and 3 were set up. Those are off-balance sheet entities, and Maiden Lane 2 was designed to take care of the securities lending problems. And it was funded by a mixture of government and AIG money. Maiden Lane 3 was to take care of the CDS problems at AIG FP. So you can see that by the fact that they had to set these two entities up, you can see that both problems were real problems at the time. AIG made payments to counterparties, which ended up drawing quite a bit of negative publicity. A lot of those payments, as you can see, were made in connection with securities lending as opposed to AIG FP. But people ignored the fact that they were related to securities lending. You see here that Chairman Bernanke distinguished, a lot of people said, well, how could you have rescued AIG if you didn't rescue Lehman? What's the difference? So, as Bernanke makes the distinction here, he says AIG was solvent, Lehman wasn't. And I question whether that was actually true. And that seems to be part of the reason why all of the attention is driven towards the derivatives portfolio, because if you can portray AIG as a healthy insurance company that just had this one rogue guy running this one hedge fund-like entity attached to the insurance company, it looked a lot better to rescue the insurance company than if there were actually real problems at the insurance companies. Well, the insurance subsidiaries were not uniformly healthy. Now, some of them were, but the life insurance subsidiaries here had some real problems. So the orange line is the losses, and the bluish-gray line is the surplus. And so if you see that, some of the losses exceeded the surplus that these insurance subsidiaries had. And so these were some of the subsidiaries that were in real trouble because of securities lending. This is another chart showing sort of the same thing. You can measure the loss against the statutory surplus that these insurance companies had. Okay, so just briefly, insurance regulation. Insurance companies are regulated in the U.S. by states in which they sell insurance. The regulators did have the authority to intervene in the securities lending matters, but they didn't really get that there was a problem until 2007. That whole history is quite sketchy, but different regulators started to think, wait, maybe this is a problem. And it's pretty amazing to think that went really unnoticed, even as the portfolio was growing so large. They did try to take steps, but by the time they tried to take steps, it was a really big problem and they didn't know how to solve it. States work together through the NAIC, which is a voluntary organization of the state insurance regulators. Insurance companies have to maintain a certain level of capital, and if they don't, the insurance regulators can go in and seize the company. The insurance companies don't go through bankruptcy. They're wound down through a state process. This is the risk-based capital system, so they're required to have a ratio of total adjusted capital to the authorized control level, which is a prescribed level, and then if they fall below a certain level, that's when the insurance regulators start to take action. This is a very hard diagram to follow, but let me just point a couple of things out to you. So you can see in both 2008, the adjusted capital was much higher, the red on the left was much higher than the purple next to it. And I'm sorry, that's 2007. And then 2008 is the orange matched with the blue. So again, it looks like AIG was in great shape. Now, this is an aggregate number. But what's not told is that in the intervening time period, AIG had to put in lots of capital into these companies because you can see the negative lines were the losses that they suffered. And so given the severity of the losses, AIG was forced to make capital infusions. Otherwise, you would have had the state regulators have to come in on some of these insurance companies. So AIG's insurance companies, some of the life insurance companies were in serious trouble in the fall of 2008. Those troubles were being felt at the parent level. And if the Fed hadn't engineered the bailout, AIG was ready to file for bankruptcy, and then some of those insurance subsidiaries would have been taken by the insurance regulators and wound down. Well, I think that allowing AIG to fail would have been the right answer. it obviously would have been very painful at the time, and I don't want to diminish that. Market discipline is often incredibly painful, but it's shorter lived, and so I think that you would have ended up with a better situation. It would have been consistent from a regulatory standpoint. But even if the government had decided we can't, in September 2008, allow AIG to fail, they could have rescued it, and then as they discovered the depth of the problems at AIG, they could have then allowed it later to go through bankruptcy. There were other points where they decided to put more money in, and that would have been a possibility to let the company declare bankruptcy. And there were pieces of AIG that would have come through bankruptcy and moved into other hands and would have been fine, but there were also a lot of broken pieces of AIG. A lot of people tell the AIG story and they say, hey, this was an unregulated company, regulation is the answer. But a lot of their problems did emanate right from their insurance companies, which were well regulated. I'm not intending to condemn the state insurance regulators. What I'm trying to say, though, is that to assume that the Fed is just going to do a better job, I think it's very unnecessary. Well, there's no basis for having that optimism. The Fed had its own regulatory failures, and the Fed doesn't even know insurance very well. So to assume that they're going to be able to figure out problems the next time doesn't seem like the answer. And then another thing that AIG has been used as the poster child for is derivatives reform. And again, I would argue that saying that AIG was brought down just by derivatives it's not the whole story, and I think that has really been used for derivatives reforms that wouldn't have even affected the situation at AIG. Well, my solutions, as you might imagine, are based on getting people to bear the risk of loss for their own bad decisions. We need to make sure that shareholders and creditors are on the hook when things go badly. We need to make sure that bailouts aren't an option. And then we should try to make bankruptcies work better for large financial companies. And there is some work being done on this, which I think is really important. It's important for creditors to know that when there's a problem, those problems are going to be resolved through bankruptcy, which is much more predictable than something like resolution, which is the new tool under Dodd-Frank. A lot of people argue, hey, AIG was a success. We made money. We got $22 billion back. That's a great deal. If we can do that kind of math, I'll borrow money from you on that with that kind of a return, because if you do a risk-adjusted, I had a coworker who's an economist do a risk-adjusted return, and it's actually negative 20% over the time period. It's a back-of-the-envelope calculation, but the point is, if we were in the investment business, there would have been a lot better investments to make than investing in AIG. And the government should never be portraying itself as an investor, because that's obviously not why it went into AIG. But to trumpet the returns I think, is misleading. All right. I'm happy to answer any questions. I know that was a lot of material. If anyone's interested, I also commend you to read the paper, which has a lot more detail.